Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Friday, December 30th, and then we'll see how things look for a brand new year, 2023, starting on Tuesday, January 3rd. We had a down day and with below average volume, and so things were quite a bit negative earlier in the day, but we were able to recover quite a bit going into the close when folks started to come in. Maybe it was a buy program or something really pushed prices back up. And because we had below average volume, it was kind of easy. You have some sizable trades coming through, and that can really push the market one way or the other. In this case, it helped things to rebound. Before I get started in the video, I just want to remind you that on January 7th, there is a free webinar that is available to you. I'm not connected with this. I will just be a fellow participant in this webinar. And on this next screen here, it just says that on Saturday, January 7th, starting at 9 a.m. Eastern time, so you may have to adjust that for your time zone. The only thing that you have to provide is your name and email address, and this will focus on the outlook for 2023. We'll just have to see what interesting things we may gather. Some of those I may incorporate into the videos that I do, in addition with the other things that I already incorporate. So let's go back and talk about what happened. Right at the open, the futures were pretty weak before the open, and then we ended up gapping lower down below the daily pivot at 38.40. And we even quickly went down below S1 at 38.17. As the day went on, prices chopped above and below S1 and then hit support at just about 3,800 before rebounding slightly. And then we got back up to the daily pivot going into the close. And a lot of that was movement that could probably be attributed to the low volume. We ended up being down 0.25%, and volume was below average, and we're still in holiday mode. Things may pick up again as far as volume is concerned in the upcoming week, but there's still a lot of folks that may continue to take the next week off and then come back the week after. And so that's when you might see things really start to pick up again. The technicals are still negative overall. We have one oscillator that I'll show you that is trying to turn positive, but other than that, we're still in a pretty negative environment. We're also very range bound right now. We've been chopping sideways for some time, and we're just kind of bouncing around within a range. The markets are still really fixated on this inflation and interest rate scenario. Of course, a lot of people are looking back on 2022 and realizing that this is a very challenging year, not only for professional money managers, but for individual investors, where what we've been seeing over the last few years is a lot different than what we saw in 2022. It was the environment has really shifted, and it's been a lot harder to try to figure out, are we going to go up? Are we going to go down? Are we going to go sideways? Instead of this buy and forget that we could do back since the COVID plunge and then going in through 2021. A lot of that had to be thrown out the window, and those folks that really suffered some losses were trying to take the tactics that they used over the last couple of years and then apply them to 2022, and ended in a lot of frustration when those same principles didn't necessarily apply. We have to change and shift our approach as the market is shifting. Anyway, here is an intraday chart showing how we gapped lower down below the daily pivot. We quickly shot down to S1, and then we bounced around S1, a little bit above, a little bit below. We came down almost to the 3,800 level, set a bit of a base here, and then this is some strength that we saw going into the close. We still were down, but we were able to come back above the daily pivot. One thing to be reminded of is that every day there is a daily pivot point chart and an intraday chart that I update, and I post that under the community tab on the YouTube channel. Let's go back and talk about some comments. Not a lot has changed. If you've been watching these videos, a lot of the points that I've been stressing over the last few videos, you're going to get those again here. We're trying to figure out is a Santa Claus rally going to happen? It looked earlier in this week like that might be happening, but then that kind of fizzled out. We still have 2 days left in this window of the Santa Claus rally. And sometimes we see some positive things because you have folks that are getting ready to deploy their money, whether they're individuals or companies. And a lot of times they'll do that right on the first trading day of the year. If you see a real influx of money coming into the market to buy things, that could really prop things up. So that's part of the seasonality or the Santa Claus rally that we've been talking about carrying over into the first 2 trading days of the year. China will end their quarantine requirements. They're getting a lot less strict with those, and a lot of those will kick into gear on January 8th. That could help companies that deal with the supply chain, whether they're doing business in China or companies that are getting things from China. That may help things be able to arrive to these companies. The S&P was down 19.4% for 2022. That goes from the end of 2021. That's how I calculate it, from the last trading day of 2021 through the last trading day of 2022. So it was a pretty frustrating year. We've been seeing some really large gains in the market, and now to have a pretty significant downward movement has been really disheartening for a lot of folks. And all of the markets have really suffered. Energy has held up quite well, and the dollar, even though it's seen some recent weakness, has been holding up. But a lot of the other areas, the cryptocurrencies, and gold, and a lot of those things that people usually go to when we hit difficult times, those really struggled this year too. And I have a chart to show you all the different markets here in a little while. The VIX is still acting kind of strange. We're seeing that correlation between the S&P and the VIX really continue to climb, and I'll show you a chart of that. Folks are really concerned about the earnings per share as well as the valuation of individual companies and the market as a whole, and that could really put some pressure on prices. In Friday's session, the dollar declined and interest rates were up. The dollar declining may give some support to stocks, but interest rates being up, that provided some headwinds. On a short-term basis, we still have some of our PMO studies and our stochastics that are showing us some extreme negative readings. Don't have anything in the intermediate term right now. The yield curves that we've been following continue to be inverted. The 30 to the 5 switched over for 1 day this past week. It then switched back, and that's why I changed it back to the white color here, where I had it as gold when it switched back, and then yellow when it went back again to being inverted. Sentiment is still fear. Sentiment is still negative. We're still showing fear, and we're kind of going with that because we're not really getting an extreme reading at this point. When we really take action and use this as a contrary indicator is when people are getting extreme positive or extreme negative. We're just in the fear area. We're not extreme right now. The economic report that came out on Friday was the Chicago PMI. It came in at 44.9, higher than the 44 that they had expected. Last time this came out, it was at 37.2. So it's showing some improvement, but it's still below 50. When it's above 50, that shows the economy in that Chicago area is expanding. When it's below 50, that shows that the economy is contracting. So even though it's improving, it's still contracting overall. Our trend is negative, and it's still getting stronger. The ADX is slightly above the moving average, but we are still below 20. So if you use this a little more aggressively, you like it when the ADX goes above the moving average, and you may jump on that trend. It's a negative trend because the red line's still on top. Others who are a little bit more conservative, especially since we've been chopping sideways, you may want to see the ADX get back above 20 before you actually use that to make decisions. Our bias, I've kind of kept it in the positive area because how we ended the day on Friday can be seen as positive. When you look at it on the chart, we were down at 3,800 and we bounced up off of that. Even though we had a down day, we were down a lot more than where we ended up closing. On the other hand, it was on below average volume. So we want to be suspicious of that. Plus, there's a 3-day break now for the holiday before trading will resume on Tuesday, and anything can happen within that 3-day period. And I'm keeping our momentum at mixed because we still have this positive seasonality. We're chopping sideways. We could go up or down from here on a momentum basis. And again, bias is usually if we had an up or down day. Momentum is the last 2, 3, 4, 5 days kind of taken together where we get a consensus of what has the market been doing overall. This I picked up on Twitter. This is the same gentleman that the charts after this that I show you where we compare the S&P right now with what it did back from 2006 through 2008 and the VIX chart. Well, he posted another tweet here, and it just says that S&P 500 earnings per share estimates, they're coming down faster than sales as profit margins are compressed. That's pretty negative to say all of that. Looking at this chart, the one that we're kind of paying attention to is the white line. That's the earnings per share. And they've been coming down overall. And that lends itself to stock prices going lower because it's ultimately earnings that drive stock prices. In the short term and even longer term, it may not seem that way because there are a lot of companies out there, they don't earn anything, but their stock keeps going up and up and up. Well, at some point, that has to be rectified. And for the market as a whole, we're seeing the earnings per share coming down. This orange line here is their profit margin. That's also showing a decline. And then sales, even though they're declining, they're not going down as fast as these other two. And that could be more negative going forward. Here is the other chart that he posts where the white line is the S&P right now, showing how we've been coming down. Are we going to continue to match what has been happening in that 2006 through 2008 period? So far, it kind of looks that way. But when we look at the VIX chart, it's kind of keeping at a really low level right now. It's not spiking up. And that's why the VIX is acting weird right now with that other chart that I'll show you. If we really start to fall, we might see the VIX really spike up, but we're just not seeing that yet. Here is the other chart, the VIX to the S&P 500 correlation, where this has really been spiking up. I have it highlighted here with the current reading. And when we go up, hit a spike, and then come back down, you see these red lines here. These are other times when we had really high readings with this correlation. And then if you look down at the bottom, you see what the S&P 500 did after that. And more often than not, it suggested short to intermediate term weakness. Then our ulcer index, fear is still growing a little bit. This is another measurement of fear called the ulcer index. It continues to advance, so it shows that fear is increasing slightly. The midpoint here is the moving average. When we're above this, that means there's more fear. When we're below it, that means there's more greed. Here's the equity put call ratio. After giving us this really, really high spike a couple of days ago, it's been coming down. It's still at a pretty high level, but when you compare it to this spike, it looks rather muted. Here's a 5-period moving average where we did spike up and start to come down. Now we're going to see, is that going to have an impact on the market? Because if you look at the longer term chart here, this is where we're at. We're coming down off of that spike. When we spiked before, oftentimes that marked a low in the S&P 500. Well, we've been chopping sideways. We're not really setting any kind of a low necessarily right now. If you look at these other lows, that's when everybody was freaking out and it was like, get rid of everything. I don't want to own this anymore. And the news is all talking about how the market's going down, 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 and everybody's freaked out. We're not seeing that. They're freaked out, but it's more orderly right now. We want to see more of a critical mass with movement to the downside before we can really look into this signal. Now, is it going to be different this time? Maybe. This could give some support to the S&P 500 at the beginning of 2023, but it's not necessarily characteristic of what we've been seeing on this chart in the past. Here's the trend showing how the ADX is trying to climb back up. It's slightly above the moving average. The red line's on top, even though it's declining. So we would default to a negative trend. But see how we've been just chopping sideways. We're in a pretty tight range right now between about 3840, maybe 3850 and 3800 on the downside with a few dips below that. So we want to see, can the prices break out of this range to the upside, or are they going to break down? And we don't know when that will happen necessarily. But given how these charts usually behave, the longer we stay, it's like a coil that you wind up more and more. The longer we stay in this, the more powerful the move tends to be, either to the upside or to the downside. Here is one of our oscillators, the slope oscillator, that's trying to turn back up. All the other oscillators are still negative. This one's a little more touchy. I consider this one of our short-term oscillators. And it's just, as it recalculates itself, it's seeing things as a little more positive. So we can take that and go, okay, we'll keep that in mind. And we want to see some confirmation from our other indicators. Our BPI continues to go up a little bit. It's pretty much flat. It is negative because it's below 50, and we're still having this topping pattern. This is another thing too. When we see these blow off tops, that's when the market tends to reverse and come down. Well, where's the blow off top in here? I mean, we've been just chopping around, and then we drop down here and we're chopping around. So we're not seeing any kind of critical mass movement currently. Here's the PMO studies, where the PMOs that are rising, it is declining, but not extreme in the negative. The buy signals, that is extreme negative and trying to bounce back up, where the PMOs that are above zero continue to decline. Here's stochastics. We're not extreme with the short-term stochastics, but we're still extreme with the intermediate term and coming back up out of the long term. And please be reminded, I take the short term and then I further subdivide it into short term, intermediate short term, and then long short term, if that makes sense. Here's our daily chart. We closed just a little bit above the daily pivot. That's considered positive, but we are still below both of the 50 and the 200-day moving averages. And then down below, we see where volume has been really, really light all week. Here's our moving average tree showing that we are down below all of the moving averages that are plotted on this chart. The summation index, another positive thing could be we're seeing the volume turn up a little bit before we're seeing price do that. So that is just something positive on the back burner, but we want to see confirmation of price turning higher. New highs, new lows continue to show that the internal structure of the S&P 500 is weaker. We're not really seeing an expansion of new highs or new lows. We're just chopping around, but we're continuing to go down with our 5 period and with our 10 period. The Elder Impulse system is still neutral as the S&P 500 chops sideways. The Swindling Trading Oscillator going there, we're seeing a little bit more of a match. We saw kind of a mixed signal after yesterday, but after today's session, we're going back up a little bit with the Swindling Trading Oscillator based on price and volume. So there are some glimmers of hope in the background that we don't want to really ride on, but we don't want to totally throw them away either. We're also maintaining support according to the Ichimoku cloud, where we came down slightly below it in Thursday's session, only to come back up and then close above this in Friday's session. Short term, we're still holding up with our short-term fib retracements going from the August high to the October low and the September high to the October low. So as we chop sideways, the support is still holding. We can also say that for this longer term chart, going back from the COVID low to the all-time high, and then another high that was set back in, or a low that was set in 2020 up to the all-time high. Way over here on the right, we're just slightly on or a little bit above this fib retracement level. And with the thickness of the lines and the fact that I free draw these or do draw them by freehand, they may not be as accurate as if it was drawn by the computer. We're still above support on a weekly basis on this chart, where we're slightly above the 38.2% retracement, and we're still above the 200-week moving average. So that's more positive. For those that have been watching the videos for a while, you'll know that when we're going down, I look for reasons why we could go up. And when we're going up, I look for reasons why we could go down. I want to avoid getting caught off guard. or hit with something that I just wasn't anticipating. If we kind of do things in 180 degrees viewpoint, I found personally that that helps me have insight a lot greater. Because if you buy something hoping that it will go up and it does go up, well, that's great. But if you get to the point where something goes down and it goes against you, it's like, how'd that happen? I didn't see that coming. Well, if we look at all of the things that could go against the current trend or what you want to have happen, I found that we can react to that a lot better and be proactive instead of reactive. We're also just underneath the trend channel, and this trend channel goes all the way back to 2009. So this is very, very long term. The mid caps, I pointed this out in yesterday's video, we're just starting to register a golden cross. This may show a little bit of weakness because price is below both of these moving averages. But for right now, it's enough to have a golden cross here. And then with the Dow, we're above the 200-day moving average and kind of dancing along the 50-period moving average. This golden cross seems to be holding up, but the Dow is chopping sideways as well. This is an intermarket analysis chart, just showing all the different main markets that I focus on and how did they do from the last trading day in 2021. Not surprising, oil was up the most. It actually performed better at 27.25. And it was up a lot more. My goodness, it was up over 65% earlier in the year, actually back in late spring, early summer. And then the next best performing asset in 2022 was the dollar. Even though it's seen some recent weakness and has been coming down, it has been holding up. Gold, which is supposed to be at the moon by now, it pretty much ended the year unchanged. It was down 0.09%. And you have a lot of folks that really like gold. And I like gold. I have no problem with gold. But when no matter what happens, they rationalize it and justify it by turning things around to say gold is still good. Well, gold is good. That's kind of beside the point. But what's its price action going to be? And you have a lot of folks that they don't care what the price is. They just buy it when they can because they are more interested in the asset itself rather than trying to go with some kind of a trend, because dealing with the precious metals can be very difficult if you're doing a trend-based system because they can chop all over the place. And then here is the S&P down here, the black line, and then the price of bonds. And as bond prices go down, interest rates go up, and they have been the worst performing asset in 2022. So what's our outlook then for Tuesday on January 3rd? The markets will be closed on Monday in observance of New Year's. The technicals are still negative, but we're still wondering. We have 2 days left in this window. Will that Santa Claus rally be able to happen? We have the IHS Market Manufacturing PMI. Their final reading will be coming out, and construction spending. So not a real big day economically. And then the list of geopolitical events, I have the whole list here, and there could be something that comes flying in from left field that isn't even on this list, but these are just some of the main things that have been happening. The markets are still really fixated on the inflation and interest rate scenario. That's what's driving the market, coupled with the earnings per share and projected earnings going out into the future. So we just have to take all of that, but be aware over a holiday weekend, weird things can always happen that can influence the market. Our scenarios can't really go with the down one because we're still not really trending. The ADX is quite weak, but the technicals are negative. So if you wanted to default to something, it would probably be to the negative side because we're in that very tight range. We can't go with the up scenario because our technicals are still really negative. And our scenarios that we look at, which I haven't shown those in a while because they really haven't been doing anything. They've been deteriorating. In our sector rotation, we still have value, which is very much outperforming growth. Anytime that seems to be switching is about the time the market stops and goes back into this value over growth mode. And our positive setups are not really giving us anything currently. So our technicals continue to be negative. We have to try to get back some moving averages, pivot points, fib retracements. which may act as resistance if we go up or may provide support if we go down. So we're going with this sideways trend because the ADX is below 20, although it is getting a little bit stronger, but it is negative. So our conclusion, the S&P is negative and in a range and has been in a range now. In the short term, we're negative and just a little bit oversold with our PMO studies and the stochastics. Intermediate term, we're just flat out negative with nothing really registering extreme negative. Long term, we continue to be negative because we are below the 200-day simple moving average. So I want to wish all of you a very happy new year. And I hope 2023 is your best and most prosperous and healthiest year that you will have yet. So it's been a real honor to be able to provide these videos for you. I really hope that you find them helpful as I look to improve them and add things and change the way that I present things. So have a really, really happy new year, and I will talk to you in the next video.